Okay, so we've looked at accruals, and let's go back and look at prepayments. So prepayments are just the reverse of accruals, right? With accruals, we had the situation where this was the situation. So conceptually, this is the situation. Always important to look at it from that angle. Two companies, A and B, exactly the same situation. Business relationships, transactions, events. In fact, if you like, same company, I'm just creating a scenario where we haven't included a rent in one situation and we've included rent in the other situation. So when you look at company B here, you can see again that because we didn't include the rent for company B, we have a situation where it appears company B has actually done better than company A, which would be misleading to stakeholders, which is why these adjustments are necessary. If you have used the rent, even though you haven't paid for it, you have to include it in your income statement. And you saw what we did. We went through the process of creating a rental account, creating an accruals account to show that. All right, let's move to prepayments. I guess if you can imagine, the opposite must also ring true. So what we have here is a situation where we have exactly the same scenario, the same company, company A and B, exactly the same business environment, both income, both cost of sales, both gross profit, light, 1,000 and 1,000, water. Let's come back to rent. Now here we have a situation where company B, because typically how it works is you haven't received your invoice, but you guesstimate. You think company B thinks, oh listen, we used about 7,000 last year. We will pay 7,000 again this year. And you get to the end of the year and you realize that, well, really, we've only used 3,000 because the invoice comes through at the end of the year and says, look, you only have to pay 3,000. Now, many students say to me, but Oyen, why can't we just get the money back? Well, you could, but because you're dealing with an electricity company and it's your electricity company, you're going to be dealing with them again next year. Well, why get the money? Why don't you just, which is what typically happens, you just don't pay as much in the next periods. And this is what typically happens. So you can see here you've paid too much. You've paid 4,000 too much. So logically you should be able to pick that up first of all, to recognize straight away that you've paid 4,000 too much. And we need to reduce that expense in your income statement. In effect, you have created a little asset, a little current asset, a prepayment. You are owed at the end of the year £4,000 by the electricity company. So let's sort of see how that works. Let's go to our screen again. So what must have happened was, during the year, you would have had rent and bank. And you would have gone like this. You'd have gone 7,000, 7,000. That's what you'd have done. Maybe on the first, I don't know, somewhere during the year, it doesn't matter, but you'd have paid this for the year. I don't know, if you like, you can put a date, 1st of January. Right? Just because you were being prudent, you were being good. Now we get to the end of the year, 31st of December, and an invoice has come through and says, listen, dude, you just owe 3,000. Well, if you just owe 3,000, so that we don't end up transferring 7,000 to the income statement, what we do is let's use a green pen this time. Yes. We create what's referred to as a prepayment account. Yes. And what we do is we credit our rents with 4,000 and we debit prepayments with 4,000, because this means therefore that we will be transferring to the income statement 3, so this account can close off. You're fully aware anyway that the accounts must close off. The expense accounts are only prepared so that we can carry and transfer things to the income statement. That's why we prepare all our expense and income accounts, right? They're all prepared. They're, if you like, pawns for the bigger picture, the income statement. But these guys, if you like, are statement of financial position accounts, and they must be carried through into the balance sheet. Yes, so we now have this, if you like, carried down 4,000 yes, and brought down 4,000. It's on the debit side. It is an asset, a current asset. Yes, and we can see this under current assets, this issue of prepayments. And this is what's going on with the prepayment, the exact opposite. So you start the year knowing, if you like, that you have a current asset in place that you can use towards your rental expense for the next year. Let's quickly go back to the slide and sort of see, make sure we tie this up. There's an example that I want us to look at. And this, in a way, it's the reverse of the earlier example we looked at when it came to when we had rents. So here we have a scenario where it says, what if your rental charge for the year is 1,200 and you end up paying 1,400? How do you adjust it? Well, you know that it must only show 1,200. Why? Let's go back to the core matching concept. The core matching concept states that, let's just go back up here so we can read that. Here we are. We are trying to judge all the events in a period. Our aim is to ensure that all expenses relating to that period are included in that period. We're not interested in anything outside the period. Yes, our aim is to ensure that we have the right expense for that right period. You only used rent of 1,200. Well, that's all we want to see in there, because that's what generated the income for that period. Yes, we want to see your ability to create profit. Yes, so we must match the income with expenses. And here we are. This is what we're saying. Let's see the example again, right? And in this example here we are. Oops, let's come here. Yes. Yeah, here we are. So here, rental charge 1,200. You ended up paying 1,400. Yes. Now this doesn't really matter. You could find this out at any point in the year, but this is how you get better at when you're doing your double entry, because you know in the end you just know what side to put what on. So here we are. You know, you could get a question that could, you know, this is all part of exam practice as well. So here we are. This time we're dealing with electricity and bank. So it doesn't matter if you're told that, oh, well, you know, you had paid 1,400. You could have been told that first. It really doesn't matter what you're told. The point is, you know what goes where. If you're told that, oh, you've paid too much by 200, if that's the first thing you're told, well, you know that, well, if I've paid too much, I'm going to have a current asset of 200, and that's going to have to reduce my expense of 200. You see where I'm going? Then, you know, and then if you're told, well, you actually paid 1,400 out of the bank, well, then you know that there's 1,400 coming here and 1,400 coming out of the bank, which means that what must be due for the income statement must be 1,200 transferred to the income statement. You see, so this is how you start building up the skill of knowing what goes in where, right? Remember, it's not always nice and orderly. You know, so you know that, well, if this goes there, debit this, debit this. You know, this is a current asset, debit the current asset. Well, we must be crediting electricity to reduce this 200 reduces this 1,400. And so this is what transfers to the income statement. And so we can close this off. 1,400, 1,400. And we are done. And this is how we deal with prepayments. Okay, great stuff. I will see you in the next video. We'll be talking about bad debts.